Thank you so much, everyone, for joining us. We're pretty excited about this product, and the main focus of this is to provide insight on what the new SBA 504 refinance regulations are and how it kind of equates to our applicable lives and practices in our own portfolios and as we go out looking to help our clients. So I'm Danny Mangum, Mountain West Small Business Finance. I've been here for about 11 years now. Just really enjoy what we do, enjoy working with all of you, and really enjoy helping small businesses continue to grow and progress in the areas of operation. Some of you know that we are a Wyoming statewide CDC and a Utah statewide CDC, which allows us to operate in those two states, and then also any county that borders Utah. So we do some stuff in Clark County, Las Vegas, Arizona, Idaho, Western Slope of Colorado. So we're excited to have everyone here. We're especially excited today. Our presenter is Wayne Williams from NADCO. He's Executive Vice President of Regulatory Affairs, which means he works a lot with the people on the Hill and SBA and making sure that what we want to have happen in the 504 program happens. And then once the legislators make law, Wayne works with the SBA to make sure it stays that way and it doesn't get changed too much, fingers crossed. So we wanted to have Wayne on today because when you come to us and ask us questions, if we don't know the answer, this is the guy that we go to. Wayne comes from the CDC side and then migrated over to work for NADCO, who is the head of our trade organization and kind of the grouping of CDCs. So this is the guy we go to when we have a question that we need answered. And if he doesn't know the answer, he knows the right people to call higher up to get us the answer. So we really appreciate his time being here. This is a webinar Zoom feature. So the communication, you're as an attendee, you're muted and your video's muted as well. But we do have this Q&A box down here, and I'll be monitoring that Q&A box throughout this presentation. So as you have questions, please pop those into the Q&A in the chat, and then we'll kind of go through them and pose these questions to Wayne as we go through. But once again, thank you so much for attending, and we'll turn the time over to Wayne. Thanks, Danny.
I appreciate you guys inviting me to participate in this, and I hope we can make it as meaningful as possible for everyone. I'm going to share my screen now just so everyone can see the prepared remarks that I put together for you. So hopefully everyone can see this now. Our slide deck is up, and we're going to be going through the changes to 504 debt refinancing programs. As Danny said, the whole goal of these changes was to improve access to capital for small businesses. These changes were meant to, fundamentally, hopefully shift the conversation about debt refi and allow 504 to play a more meaningful role in that, to help small businesses tap into their existing equity, to not only help with recovery efforts as we've been coming out of this COVID pandemic, but also to position the small business for further growth. So as Danny said, I'm Wayne Williams. I did just want to piggyback off a couple of things Danny said, that I've been with NADCO now for a couple of years. I was on the board prior to that. I do head up our regulatory affairs training efforts and work a lot with our team on the Hill. Prior to joining NADCO, I spent 23 years with a CDC, but then prior to that, 10 years as a commercial banker. So I hopefully bring an insight that what commercial bankers are interested in and how they approach these subjects to try to better help their clients. So let's get into some of the meat of this. The changes to, we're going to go through today, I guess, changes to debt refi programs, but I want to talk specifically about the two programs that we have. It's debt refi with expansion and debt refi without expansion. As you guys know, those are the two major, those are the two refi programs that we have. And the new legislation and new regulations did make changes to both of those programs. So we'll go through those in detail. And then I've got some project structure, deal structure, case studies for you as we, so you can see how this might fit into something that you're looking at. And then we'll come back and do a Q&A at the end. So first off, I just wanted to point out that the debt refi changes are permanent changes to the 504 loan program. SBA issued them in an interim final rule on July 29th. And this is actually implementing the legislation that was passed in the Economic Aid Act back in December 2020. But SBA issued the regulations as an interim final rule on the 29th of July 2021 with a 60-day comment period. And then at some point, they'll come back in and potentially tweak these things based on the comments to turn it into a final rule. But these are permanent changes. They're available now and you can utilize them now. So let's get into the first program, the 504 Debt Refinance with Expansion. This program we've had since 2009. It was originally advanced and 504 was authorized to do limited debt refinancing when we had an expansion project as a part of the American Recovery and Rescue ARA, the ARA legislation from 2009, as you guys recall, back during the Great Recession. So the change here that we have, there was only one change to this particular program. And as you may remember, with this program, the amount of the debt that can be refinanced in a project when you have an expansion project was previously limited to 50% of the new expansion costs. That's been increased to 100%. So the debt refi can now be 100% of the new expansion costs. There were no other changes to the program, and I put some reminders in here for you, just so again, as you're utilizing this program, the debt being refinanced must meet an 85-15 test, is what we call it, 85-15 test. And the way that's interpreted, that the original proceeds of the debt that's being refinanced, that original loan that was ultimately put in place, originally put in place when the fixed assets were purchased, at least 85% of the proceeds of that original loan must have been for the purchase of eligible fixed assets. The remaining 15% could have been used for any purpose. I talk about this now because you're going to see this as consistent in the other program as well. So the original loan could have been refinanced multiple times and added on to over time and still be eligible to roll into a debt refi with expansion, as long as the original loan, the purchase money transaction, meets the 85-15 test. The debt must be secured by fixed assets, and this program has always allowed the refinance of government guaranteed debt. That includes SBA 7A loans, existing 504 loans, USDA, really any government guaranteed debt could have always been refinanced in this program, debt refi with expansion. The debt refi can also include prepayment penalties and any other financing costs to pay off that underlying debt. So if you have a prepayment penalty, you have swap fees you need to unwind, those kinds of things can be included in the payoff of that underlying debt. In this program, we've also always had, if you've used this program in the past, the debt refi must meet what SBA calls a substantial benefits test. And that is that on the amount of the debt that we're actually refinancing, there must be a 10% savings in the monthly payment on the debt being refinanced. It's only applied to just the debt refi portion, so it has nothing to do with the expansion. So you just have to generate a 10% savings on the debt refi portion alone. And then lastly, this program has that the applicant must be current on all payments due for the preceding 12 months prior to the SBA application. SBA just doesn't want to see, troubled assets or troubled loans being refinanced into an SBA product. And that's the reason that requirement is in place. So I have a couple of examples here for you as to how this would actually be used in daily activities. So you have a request coming in, you've got a business owner that has owner-occupied real estate. It appraises for $1 million in this example. There's current debt of $700,000, so we have $300,000 in existing equity. And then the borrower wants to put an addition onto the building, and this addition is going to cost $2 million. This is a prime candidate for the 504 debt refi with expansion product. So to structure our uses and sources of funds, we would pull in the existing equity of $300,000. You'd be able to refinance the entire debt balance, current debt balance, $700,000. And then you'd have your new expansion costs. In this case, I've got them kind of itemized there just to to show you what can be done. And so those new expansion costs total $2 million. So we have a $3 million project. Our standard 50, 40, 10, 504 split. You've got a new bank loan of $1.5 million. You've got the SBA portion at $1.2 million, and then the borrower's existing equity of $300,000 rolls in the transaction. The important rule here is that previously the debt refinance was restricted to no more than 50% of the new expansion costs. In this case, it's now 100% of the expansion costs. So you've got new cost of $2 million. As long as the debt doesn't exceed $1 million, you can pull in up to $1 million in the debt refi portion. And you just add that to your 504 project. Now, the next example I have is what happens when you have the debt that exceeds that cap. So in this case, we've got an owner-occupied facility, appraises at $3 million, and the current debt balance is $2.5 million, and the borrower wants to put this $2 million addition on. So in this case, the existing debt of $2 million exceeds your debt balance of I've got an error on my screen here. I apologize. The debt refi is limited to $2 million. You've got a balance of $2.5 million, but the debt is limited to $2 million. So the reason I put this example in here for you is I don't want you to think that just because the debt balance exceeds 100% of the new expansion costs, that this project cannot be done with 504. It can. So in this case, the eligible debt refi is the $2 million. We give credit for the $500,000 in existing equity, and we have our $2 million in new costs. So we have a $4.5 million project, and we can split that, and the borrower's contribution is the existing equity. That must remain in the transaction. Under this product, there is no cash out of the borrower's existing equity. And the issue that comes up here is, though, what do we do with this extra $500,000 that's left over that we were not able to refinance in our 504 project? And SBA has a plan for that. They allow you to take that extra $500,000 and just put it into your first trust loan. So your final first trust loan would be a $2.7 million because you're taking all of what SBA calls ineligible debt refi because it exceeds the cap, and you're just adding that to your financing outside of the 504 project. So again, this example was just put in there just so you guys could understand that these projects are still eligible. It's just they have to be structured properly. And I think that's it for the debt refi with expansion. For most of the changes that came in the Economic Aid Act and in the new regulations were for 504 debt refinance without expansion. So just a couple of things here. This product originally launched as a temporary program back during the Great Recession back in 2010. It was part of the Jobs Act back then. SBA did bring it back in 2016 as a permanent program, and borrowers are able to refinance existing debt and cash out existing equity to fund eligible business expenses with this program. The debt can be on either owner-occupied real estate and or capital equipment. There are a couple of caveats with respect to loan to value. There's a maximum 90% loan to value if you're doing debt refi without cash out. If you're doing debt refi with cash out, the maximum loan to value is 85%. And that cash out amount cannot exceed 20% loan to value. There were no changes in this, so we've been living with this since 2016, these max loan to value caps. and the max on the cash out amount. Just a couple of reminders here that the cash out for the eligible business expenses can be for any business expenses that are payable over the next 18 months. It includes salaries, rents, utilities, pretty much any operating expense that you have, the purchase of inventory. You can even allows you to pay down or pay off a business line of credit or a business credit card. Now, what's not allowed with the cash out is you cannot do capital expenditures, you cannot pay any personal expenses, and business acquisitions and partner buyouts are not eligible in this cash out portion. The new legislation and new regulations, I put this slide in here because there were some program enhancements. Some of you may be aware that when the program was originally brought back in 2016, it came back with a condition that if 504 ever went on subsidy and ever required, funding from Congress to keep the program alive, that 504 debt refi would have been temporarily halted. That condition is now eliminated with the new regulation, with the new regulations and new legislation. So the program will be available now, even if for some reason we were going a subsidy. But again, as a reminder, 504 is a zero subsidy program. It also eliminated the cap. This didn't really apply to Mountain West, but there was a cap in place that restricted CDC's ability to process new refinance loans if the new loan would have exceeded 50% of their prior year volume. So that cap is now gone. So no longer have to worry about a cap restricting the CDC's ability to help with refi projects. One of the big wins we got with refi is, 504 generally is a job creation program, but it's really hard to justify job creation when you're looking at a refinance project. So what was allowed during the temporary program and what has now been brought back as a part of the new legislation is that Congress reinstated what they call an alternative job retention standard, which means that all existing jobs of the underlying small business applicant can be counted as jobs that are retained through the project. Now, why is that important? It helps qualify the financing for 504. Without meeting a job creation, job retention, or some type of policy goal, a project just is not eligible for 504. But by reinstating the job retention requirement, we've now opened the door to a lot more businesses that will be eligible to take advantage of refinancing using 504. And just as a reminder what our job goals are, one job per 75,000 for all, per 75,000 of the 504 debenture amount for all applicants except small manufacturers. And for small manufacturers, it's one job per 120,000. And again, if you don't meet a job goal, you can also use readily available, I think there's 12 or 14 different public policy and community development goals. And you guys are familiar with those. It's the type of things that you would think about with government guaranteed financing. It's assisting a woman-owned business, a veteran-owned business, a minority-owned business, rural development, urban revitalization. Those are the big ones. But again, there's 12 or 14 different policy goals if you just don't meet jobs for some reason. Now, where were the major changes in the program? First off, there were things that did not change, and things that have been changed. One of the things that did not change is that your applicant must have been in business for a minimum of 2 years prior to the application date. That did not change. And again, here with this program, just like debt refi with expansion, the original note, the original purchase money transaction has to meet the 85-15 test. Again, it's the exact same test as the other program. So if you have a loan that was originated for the purchase of real estate and at least 85% of the project proceeds were for the purchase of the real estate, and that loan was then refinanced multiple times and added to over the years, that loan is still eligible to roll back into a 504 debt refi without expansion project, because the 85-15 test is measured on the original debt. The loan must be at least 6 months old. That was a change. It was previously 2 years. So the loan now just needs to be 6 months old and have been secured by those eligible fixed assets, that land, building, capital equipment, for at least 6 months. One thing that did, and that was reduced from 2 years as well. Now, the other thing that did not change is that the debt have been incurred for the benefit of the same small business that's seeking financing now, this refinance project. That's no change to that. So the other change, another change was that SBA now requires an acceptable repayment history on the existing debt being refinanced. You may remember that the requirement previously was that the borrower had to be current on all payments due for 12 months. And SBA was pretty strict about this. If the loan had been on deferment, particularly in the age of COVID, for a while, they would not allow the loan to be refinanced. And then they made a change and said, well, if the borrower makes up a deferment as if it never existed, it would be eligible for refinance. But now in this situation, they, with this change, they're simply saying you have to have an acceptable repayment history. And if there is a blemish in the most recent 12 months, it has to be explained by the applicant and the CDC in the application package. The big change to debt refi without expansion is that we can now refinance loans that were previously subject to a federal guarantee. That was previously prohibited. We're going to talk a little bit more detail about that in a couple of slides. And as before, the debt refi can be multiple loans making up the debt that's being refinanced, but each loan must meet program requirements. I've got a slide example of how we apply that. So let's talk about the considerations when we're actually refinancing existing government guaranteed debt. The first requirement is, just like 504 debt refi with expansion, that's done for all loans. For debt refi without expansion, where the debt is previously government guaranteed debt, you must meet a substantial benefits test. So that again is a 10% savings on the amount of the debt being refinanced. And there's a typo on the screen. I'm sorry. It says when calculating the 120% savings, that's a 10% savings. I apologize for that. Also, to refinance an existing 504 loan into a new 504 project, you must refinance not only any 504 loan balance that's outstanding, but also any existing balance that's on the third-party loan that was a part of that original 504. If the third-party loan has been paid in full and the 504 still has a balance, you can still refinance the 504. But you've got to refinance any third-party loan that still remains outstanding as a part of that original 504 project when you're rolling it into a new 504 project. And if you're refinancing an existing 7A loan, there are a couple of caveats here. An existing 7A loan can be refinanced in whole or in part, is the way SBA phrases this. But there are some written verification requirements. So the CDC has to verify in writing, and actually it's the borrower that needs to verify this with their present lender, that the present lender on that 7A loan is either unwilling or unable to modify the current payment schedule to match the benefits of the 504 debt refinance. That's if you have the new the new lender that's your partner in the 504 project. If you are going to be the new third-party lender in a new 504 refinance project and you're not the lender on the 7A, then the borrower must verify that the existing 7A lender is either unwilling or unable to modify the payment stream before that loan will be eligible for 504 debt refi. Now, in the case of same institution debt, if you are the proposed third-party lender and you're also the existing 7A lender, the loan will be eligible for 504 refinancing only if the lender is unable to modify the terms of the existing loan because a secondary market investor will not agree to those modified terms. Now, SBA also added a caveat here just recently in an FAQ that we asked them to answer, and that is if you are the existing 7A lender and you want to roll this loan into a 504 refinance project and you have not sold the loan on the secondary market, If you are unable, if for some reason that 7A loan, you're not able to modify the 7A loan for whatever reason, then you can still refinance this project into a 504. So there's this little extra caveat, just if you're unable to refinance. And I think the example that SBA gave on that, and we're trying to get a little more information on it now, but those that are experienced in 7A lending may know more about this. But if the loan was done like under a 7A Express product, I think was the example they were given, and that those loans really just cannot be modified or cannot be increased, then you may be able to just go ahead and be the, not only refinance your existing 7A loan, but be the third party lender in the refinance. There's another category here that if the existing debt being refinanced is non-SBA federal debt, then the CDC has to verify, and the borrower must verify, that the respective government program allows their loan to be refinanced. So I know we're working now with USDA, EDA, various other agencies of the federal government to accumulate this material about their programs, just to demonstrate to SBA's satisfaction that the loans can be refinanced. And hopefully we at NADCO will be able to accumulate that data and then share it as a whole with our industry, so that once you have that verification, like for example, once we get USDA to say yes, their loans can be refinanced, then you don't have to worry about doing any additional documentation on each individual loan. You just have that blanket statement that USDA allows their loans to be refinanced. So we're working through that process now. So some examples for you about how this all works. So let's say we have a refinance without cash out. So we have an appraised value of $5 million, existing debt of $4.5 million. Very straightforward here. You just take the $500,000 existing equity. You've got the $4.5 million refinance amount. Your total project is $5 million, and you split that 50-40-10. In this case, with 504 debt refinance without expansion, your total project costs are always equal to the appraised value of the underlying collateral. Now, one of the things I did want to just mention on this slide is that if you're just doing a regular refinance, a straight refi with no cash out, if for some reason the project collateral comes in with a short appraisal and you cannot meet that 90% loan to value, SBA will allow the pledge of additional collateral so that the existing debt gets back to a 90% loan to value. They only allow the pledge of additional collateral on these straight refis without cash out. And just a reminder again that the existing debt can be a conventional loan, it can be a 7A loan, it can be the combined balance of the first and second trust on an existing 504 project, a USDA, EDA, anything, and then it would be eligible. Even seller financing is eligible if you have a seller that can comply with all the requirements. Our second example of a refi without cash out is here. And again, it's our $5 million appraised value. In this case, we have $3 million of existing debt. So we have $2 million in equity. And I put this example in here just to show you that this project can still be done with 504 as well. In this case, the borrower contribution is all of the existing equity. In this case, say, for example, again, the borrower does not want to cash out their equity. But in this case, you can then equally split the loan balance between the bank partner and the 504 portion. And for the debt refi without expansion program, if the borrower contribution exceeds SBA's minimum requirement, in this case 10%, that extra can be used to reduce both the TPL note and the 504, provided that the 504 never exceeds the lesser of the TPL loan amount, or 40%. So I just give this example here just to show you that if you have a project that has substantial equity and they're not going to cash it all out, you can still do that project with 504 debt refi.
Wayne, can I jump in here really quick and ask you a question that we've received a couple of questions about here? What if the guaranteed portion was sold and the third party lender will adjust the terms, but nowhere near what the new SBA 504 rate would be? Is it simply that the third party note holder will adjust the rate or terms that makes it ineligible?
No, and that's a great question. And the SBA has clarified this for us. When you go back to an existing 7A note holder and whether that note has been kept or sold, the existing 7A lender basically gets one shot to match the terms, the benefit savings from the 504 refi. And if in their first response back, they're not able to fully match the 504 benefit, the 504 refi can proceed. And just moving on to our cash out examples, refi with cash out. I'll give you just another straightforward example here. A couple of things to look out for when you have these is that the total financing with cash out cannot exceed a max 85% loan to value, and the cash out portion cannot exceed 20% loan to value. So if you look at our example here, we've met both of those tests. So you just have to be very careful when you're structuring these that you keep the total financing to a max 85 loan to value, and then the cash out doesn't exceed 20%. Now, I promised you this slide. We have an appraised value of 1.5 million. We've got an existing first mortgage balance of 750 and an existing second mortgage balance of 250. Because in a lot of times, your clients will have a first and a second on their property. Now, in this case, you are able to refinance. Our example shows that we are able to refinance the first mortgage and the second mortgage, but to refinance the second mortgage, we have to prove that the second mortgage loan meets all of SBA's requirements for debt refi. So in this case, it has to be 6 months old, at least 85% of the proceeds had to be used to acquire eligible fixed assets. All the other conditions apply here. So if you can apply all those conditions to a first mortgage and a second mortgage, then the second mortgage is eligible to be refinanced as a part of your debt refi. That is the reason I put that in here. Now, if your second mortgage was for permanent working capital or for some other purpose other than the acquisition of eligible fixed assets, and you cannot meet that 85% test, the loan is not eligible to refinance. And in that case, after you structure your 504 project, this existing second mortgage may have to be dropped down to a third mortgage, or it'll have to be refinanced separately and dealt with separately. So I just put that example in there just so you can see that we can take out a first and a second if we can make, if both of the loans qualify. A couple of case studies here for you that just do not work. We have an appraised value of $1 million, but the small business owner owns the building free and clear, and they just want to tap into their equity. That project's not eligible for 504 because in order to be an eligible 504 debt refi, there's got to be a debt. There's got to be a debt that's being refinanced, an eligible debt being refinanced. Our case study 6 takes that one step further and says that our existing first mortgage is actually a line of credit balance, and the line of credit was granted for business operating expenses. And again, this is not going to be eligible for 504 debt refi because the line of credit does not meet the definition of qualified debt. It was not used to acquire eligible fixed assets. So it's critical that that debt that's going to be refinanced meet all the requirements for debt refi, including meeting that 85% test. So I'll give you a slide here just to talk about required documentation. As you're going through these things and working with your clients and prospects and potentially looking at 504 debt refi, we're going to need to collect note and lien instruments. So we're going to need to see your bank promissory note, your recorded mortgage documents, recorded lien instruments for your capital equipment, your UCCs. We're going to need to get a payment transcript for the most recent 12 months to show that the borrower has an acceptable repayment history. And we're going to need to get documentation to support that original 85-15 test. That documentation can be a copy of a settlement statement. That's generally the way you would do this. You can also look at the tax records for when when a note or a mortgage instrument were recorded to see if you can back into meeting the 85% test. If you match up the loan amount versus the transfer recordation price. In some cases, if you are not able to find any of the original documentation, if for some reason the debt is, that original purchase money transaction was just so long ago that no one has records on it anymore, SBA will accept a certification, what the SBA calls a missing documents certification, and it just allows you to, for you, the CDC, the bank partner, and the borrower to attest that everyone has made a good faith effort to collect the documents. They just can't find them, but that we still are certifying we're meeting the test. Now, if the existing debt is SBA debt that's being refinanced, a copy of the authorization would be needed. And the SBA has already told us that the copy of the authorization would also tell you whether you've met the 8515 test, if you just get a copy of that original authorization. You've also got to meet substantial benefits test as a reminder for 7A or for any existing SBA debt being refinanced. And then you need your written verification from the existing 7A lender. If it's a new lender that's different from the existing 7A lender, you just get a letter from their, or a letter or an email, something from the existing 7A lender of their unwillingness or inability to modify to match the payment savings with 504 refi. And if it's the same lender, then you need written verification that the loan was sold in secondary market and that market investor is not willing to modify. Or like I say, or if you've got some documentation that just proves that you're unable, if you are the same lender, that you're just unable to modify your loan based on whatever SBA program requirements are in place for that particular loan product.
Wayne, could you provide an example of what that would be like? Spencer, Judd, and I were talking about that this morning. And some ideas that we had was maybe their internal credit policy or something like that states that they're not able to reach a 25-year term or amortization. Any other thoughts that you have there?
Yeah, that's a good idea. Their internal credit policy doesn't allow a modification of a 7A loan to do an increase, because if you're doing cash out on the 504, you're not able to do this increase to the existing 7A loan. You have to structure it as a refinance. And if you're going to end up refinancing the debt, you're not modifying the debt, you're refinancing the debt. So I think if your normal policy procedures would force you into a refi to accommodate what 504 is doing, that's the step that you would need in order to allow the 504 refi to go forward. So, and I think that would work. We're working through all of this right now with SBA as well, just to see, as we're testing the waters on some of this, because as you know, Danny, this is still relatively new to us, and we're trying to get a sense of what the folks at our Sacramento Loan Processing Center will be looking for. But that's the sense I've been given so far. On the next slide, I think this is our last slide before Q&A. This is just a sales pitch for all of us in 504 world about all the benefits of 504. We're seeing record loan volume right now in the program. We are up tremendously this year versus last year. We've got, we processed over 8,200 loans through the end of July, almost $7 billion in financing, and our interest rates continue to be sub 3%, fixed 25 years for up to 25 years. So again, it's an outstanding time to work with your clients and your prospects and try to see if 504 is a good fit for them as they're planning their future capital needs. And just as a reminder, for any new loan approved through September 30th, there is a waiver of some fees, 1.5% on the 504 side and 0.5% on the bank third-party lender fee is waived. And all new loans approved by September 30th are still eligible pending funding availability to get 3 months of CARES Act payments that are capped at $9,000 per month. Now, I will just mention that for SBA has notified us, though, if this loan is a refinance of an existing loan that already received CARES Act payments, then the refi would not get the $9,000 per month, the payment subsidies of 3 months. But there are a tranche of loans out there that were made that did not receive CARES Act payment subsidies. So they would be eligible under a refi. So, and I think, Danny, that's it for the prepared remarks, and I'm happy to continue answering any questions that we might have.
Great, thank you so much, Wayne. We've been able to answer most of them as we've gone throughout this presentation, but really quick, a couple that we've got here. 7A lenders are required to take all available collateral when they do their loan. If the property we are refinancing alone meets all of the collateral and LTV requirements of this refinance without expansion program, will the CDC be required to also take that additional collateral that was in that original 7A note?
That's a very good question. And I'll tell you, the answer that we've gotten from SBA on this, SBA makes a distinction between what they call project collateral and additional collateral. If the original purpose of the 7A loan was to purchase real estate, maybe some working capital, maybe some equipment, then the project collateral, the project real estate in this case, that's project property, that would have to stay with us. If it was simply that to meet the requirements of 7A and the 7A lender had to take all available collateral as security for the loan, then all of that other stuff that came along with that requirement would be treated as additional collateral. So when you look at the 504 debt refi, if you have sufficient value, appraised value in the project asset, in this case, like a project piece of real estate, then you can make the argument that you don't need the additional collateral, and SBA will entertain that argument, yes.
Okay, because what we see a lot is a lot of those 7A notes will end up wrapping up somebody's home.
Yep.
Something like that. And now, and especially in this current environment, they have so much appreciation in their commercial real estate that we'd be looking at refinancing. There's really no reason, nor do we want to tie up their home.
Exactly. And then, again, as you know, that's part of one of the beauties of 504 is that we don't tie up additional collateral unnecessarily, just because we do want to leave those assets available, not only to the individuals, but also to the business to the extent they may need to leverage those assets later on for working capital financing or for some other type of financing need. So
great. Another question that's rolled in: with refinance, are there any restrictions on property types, like such as hospitality, or is it just your normal 504 eligible property types?
Yep, all the eligible property types are there. I will make there is one thing to keep in mind, as most of your bank partners may know, that 504 has what we call special use properties. And if the property is a special use, SBA typically requires an extra 5% down. So in that case, your refinance would be restricted to 85%. I'll tell you that we're currently not operating under that rule, because during a recession, during a declared recession, SBA has the ability to waive that requirement in 504 debt refi and allow us to go to the full 90% in a debt refi situation. We are under a declared recession right now. It was declared last February, I think it was, February, March. SBA made the change in the summer of last year, and as of July this year, that has been reaffirmed that we are still technically under the recession designation, so that that extra 5% for special use is not required right now. So for hospitality properties, typically there would be an extra 5% down, and so your max refi would be 85%, but now we can do 90% for now.
Thank you. I'd also just like to pub in there another thing that's different with refi on special use properties like hotels, gas stations, etc., is typically on your normal purchase of a special use property, the third party lender has to be at 50% of the total project costs. But with refinance, that's not the same case. So let's say, for example, that a hotel has 20% equity in it, you're looking to refinance it, the CDC would be able to match the bank's amount, so we could split the total project cost 40-40-20.
Absolutely.
So that's another difference from refinance to a purchase. Well, Wayne, thank you so much. I'm not seeing any other questions other than can they receive the slide deck and the recording of this? The answer to that is yes. We will be blasting this out to all participants on this, and you'll have access to the slide deck. You'll also have access to the recording featuring Wayne and I talking about sports for the first 15 minutes before it got really rip-roaring. We'll keep that in instead of editing it. You know, we'll make sure to keep that in.
Gotta have something entertaining.
Yeah. Well, thank you so much again for
Sure.
for doing this, Wayne. We really appreciate it. At one point there, we had 151 attendees.
Wow.
You know, the Utah market loves SBA. They're well versed in it. This was so helpful, and we are so thankful to all of our lending partners for joining, for getting a better idea of what this all means and how it all works. And we'll just ask for your continued patience as turn times at SBA are quickening, but they're still not what we're accustomed to. And with an increased volume, I'm sure we'll see some slowdowns. Also, be aware that the folks at the Sacramento Loan Processing Center are also learning this new program as well. And so I'm sure we'll see some slip ups on their side where they won't exactly know the regulatory parameters that they're supposed to be operating in. So we might have some back and forth. It happens every time something comes out new. So thank you so much to everyone for joining. Thank you, Wayne, again. We really appreciate our involvement in NADCO and you're helping us out. So Thanks, everybody. Have a great rest of your day.